that's a more polished photo of me. So
it would have been really funny if you could have just had that photo, but then made the mouth move, like Conan O'Brien used to do. All right, here we go. I think we're live. We're live, Karen?
Yeah. We're live.
Awesome. All right, guys. Today we're live. I've got Tim Arrowwood with me. We're going to do a quick, just kind of synopsis of down payment assistance and how to come about getting those down payments set up for you. Got about 4 ways that I'm going to talk about today. The first one is going to be the more old school. You're going to be saving money, putting it down. Typically, it's going to be your 20%. You've worked 20 years or whatever it may be, 10 years to save up. You're ready to go. You got your down payment ready. How often, Tim, do you see buyers able to, in this market, come up with their own down payment?
What's happening in this market is that, we're going to talk about down payment assistance and things like that. It's been so hard for first-time home buyers that the majority of the deals that are getting done anyway, people have some sort of cash because, I've got a lot of people that are pre-qualified. They're just not able to, because they don't have enough cash, not able to make it happen. So when you were talking about 20% down, things like that, I think the big thing is, there are a lot of programs we put 3% conventional, 5% down, the USDA, THDA, some of the others that have low down payments. The challenge that I'm seeing is that, especially right now in the last 4 or 5 months, traditionally you've got your down payment, it could be 0 down for a VA, and then you got your traditional closing costs. But what's happening lately is because of the market, the lending side of things, there are very few rates that are available to the borrower that have no points, and so that's just making it worse. So, like, let's say you've got a $200,000 property, VA. Well, great, 100% financing. Well, up until recently, we can't get much. So they closing costs, no negotiations, having to be going really, really strong. Well, then somebody's got to save up enough to cover closing costs, prepaid items, but then it's been made worse because we've said, well, even if I go to the top of the rate sheet, you're still having to pay a point and a half or something like that for that particular rate. So now that just makes it worse. Now things are starting to, fortunately, I'm seeing that you're getting a little bit more negotiation, a little bit more opportunity for seller pay and stuff like that. I think I've gotten off track here, but the idea was that in terms of how many people have had money to put down. Obviously, a lot of people moving from out of state. A lot of people have big chunks of money to put down. So it feels like for the last year and a half, 2 years, that there's been so much money coming in from out of state that the down payment hasn't been a problem. Except for the first-time home buyers. Does that make sense?
Yeah, it does make sense, actually. And I think that will kind of lead into our second part of the discussion we're going to go off, which is the THDA program. I know you've gone over that with us several times before.
Yeah.
What is THDA exactly, and how does that benefit a buyer?
So the THDA is the Tennessee Housing Development Agency. It's a down payment assistance program where we've got it can be a THDA on top of an FHA loan. It could be a THDA on top of a conventional loan. But typically what we're going to do is a THDA that's an FHA loan with a down payment assistance program. So in that case, you can get a second mortgage. Is what that down payment assistance is. A second mortgage that sits on top of first. So you can get as much as 6% in down payment assistance. So if you're doing an FHA loan that only requires 3.5, then that other 2.5 that you're getting from the down payment assistance program we can use that to put towards the closing costs. So the reason I like the THDA is because you're getting extra money to put towards seller paid closing costs that you normally wouldn't. Yeah. And I'm seeing a couple $100,000 purchase price. The borrower may only need to come up with $2,500 or something like that, which is either easy to get easier obviously to get saved, or it can be more easily negotiated as a seller closing cost. But THD is a great program. I mean, it is a little bit volatile in terms of in terms of rates. It's been moving up and down a lot. Well, everything has, I guess. But it's been one of my favorite programs because it doesn't have, there's no boundaries. It's not USDA where we can't. It's got to be in the county, or you can be anywhere you want. It's actually for designed for first-time home buyers, but there are 3 counties. Paul, what are the counties that THDA? Paul, he's zoned out. So there's 3 counties. I think it's Greene County, Johnson County,
Unicoi, isn't it?
Unicoi, that you don't have to be a first-time home buyer, which is kind of a big deal, because you could sell a place and get right into a THDA. And those are counties that are they're incentivized. They actually have a higher max household income and things like that. So that's something to keep in mind. And let me take a step back and say, I really think that obviously we like for you all to work with us all the time, but I think that this discussion is really something that whoever you have a lender, it's really our job to educate the borrower, right? And if you're working with somebody that's not helping them, that should be the job that we should take off of you.
Yeah, you don't want to leave. You don't want to have them leave something on the table that could have been a benefit for them.
Yeah, but primarily because we see everything. We have the truth serum. I call it the truth serum, called a credit report. And whatever we ask for, they're going to give it to us. I mean, there's really, people tell us stuff that they won't tell you because, I got money, I got this and all that. And when we get into it, we find out, well, they don't have money, or it's cash in the safe. And so what they tell you, what they tell us sometimes is different. And it's hard to diagnose a solution to a problem if you don't have all of the blood work and the x-rays. And so we have those things. So the lender should have those things. And so I think that's the big thing that I over and above everything, I think it's great that you all understand these concepts, but it should be our job. Right. And it should be the lender's job, really, to do that work. Now to go through, like you said, now that the way I talk to a borrower is, they fill out an application. I talk to them about what they want to do, what they'd like to do, how much would they like to put down, all those types of things. Then I'll go through the application. I'll say, well, they'll tell us the assets they have available, and I'll say, well, is there anything else? Is there anything else, right? And I had somebody just the other day that they literally had $16,000 in cash in the safe, and I have to educate them on the fact that we can't. That's great, right? I don't want to know that, because if somebody breaks in, I'm in trouble, because they'll think it's me that broke in their house. But
so you're the one that took my 16 grand.
He's the only one.
I'm missing $16,000 exactly.
So
you knew it was you.
But I've got to educate them on what to do with that, right? You need to put it in the bank. It needs to season for 60 days. We can start the process closer to, we don't have to wait 60 days. But I think that's our job as the lenders, to understand what they can and can't do. And I'm asking things like when I understand that they don't have much money, immediately I'm thinking 100% financing or down payment assistance program. And then I'm looking at things like, what are their credit scores? If their credit scores are 640 and above, then I can look at the THDA. Then I've got to look at, do they make too much money? Do they make enough money? What is their debt to income ratios? And there's no way for you all to be able to know those kinds of things. You don't have the tools, and quite frankly, you should be going out and getting another deal, and not.
Is there a cap on the THDA limit? I know there wasn't before. I'm not sure.
Like the max
amount. Yeah. Or
generally, that's a good question. Let me look here.
Or is there a cap on how much assistance they will provide? Because I thought at one point it was like 15,000 or something.
I don't know that there's a max. They changed the rules over the last year, actually, to help the borrowers. In that it used to be that it was up to $150,000 purchase price. It was a set amount of money. Over that, it was another set amount of money. Right now, up to $100,000 purchase price, you can get $6,000 in down payment assistance. So, if you're buying an $80,000 place, then that percentage is way over 6%. But once you reach 100,000, then you can do 6%. So if you've got a $200,000 property, you can get $12,000. If you get a $250,000 property, then I can't do the math quick, but you would have that much available to you.
Yeah.
And then, at that point, the higher the purchase price, many times there's so much extra coming in, so much extra over and above the 3.5% that you need, that you can cover a lot, sometimes all of the closing costs and prepaid items in that case.
Gotcha.
I don't know. Does that make sense?
That makes sense. Yeah, it makes a lot of sense.
The things that, again, I just feel like that more and more lately I've been thinking about, where is the value that we bring, and I really feel like that any lender should be taking as much of that off as you can, so that you can go get another deal. And then, I'm talking to them and say, okay, I don't see that you have enough money, or maybe your debt to income ratio is higher, but we're talking about the down payment part or the cash available. So I'm like, okay, do we have any basically blood relatives that have the capacity and the want to help you with a gift or something like that?
So how does a gift work, as far, because I've actually had some clients before that a relative had to give them money, but it had to be a note written for it. There's all kinds of hoops to go through.
Absolutely, and every time. So when we get a gift, what we're trying to do is to make sure it truly is a gift, right? So there is a specific form that we'll provide, or any lender would provide the form that they like to use that says, I'm the giver. This is the receiver. This is the amount. This is where the money's coming from. And yes, this is a gift, right? So, and there's no expectation of payment and all those types of things. Now, whatever people do on the side, I don't care. I'm looking at that piece of paper that says this is a gift, because if it's a loan, then that's not the kind of, we just can't use that for those funds. So there's got to be a letter that's written. And we're going to say this is the amount, and we prefer actually to have the giver send the money to the title company or attorney's office. It's easier to document that type of thing. So the things you got to make sure of is that it differs between different programs. Like FHA is different than conventional, but sometimes primarily it's a blood relative. So it's a parent, a sibling, or a child that would be have the ability to give you that money and fit within that box.
Does it have to be someone that is a relative? Can it not be like a close friend or a business associate?
It depends on the program. And honestly, I don't remember. I always have to look it up. But like I've had a very close family friend. Well, the problem is we have to prove that they are a close family friend. How do you do that, right? So I've actually, I know it's been years ago, we had to prove that it was a close family friend, and we actually found an obituary where of a parent that had that actually mentioned this person that was a very close family friend, was John Doe, and we're using, well, they've been friends on Facebook for 14 years. I mean, it's really awkward.
That's crazy. I've never heard of that.
How do you prove that? And some of the programs, like if you're fiancés, I think
he's not listening. He doesn't care.
He's focused on. But that's where I end up. I mean, you'll find I lean on him a lot. But like some programs, you can be a fiancé and receive the money as a gift. Others, it's like, no, it doesn't count. Fiancé doesn't count. So there are times so what we'll do is we'll say, well, if we put both people, like if person A is buying the house, we could put person B on title. And so now that develops a relationship, and so we can have that person B gift the money to person A.
Okay.
They're not on the mortgage, but again, that's our job, is to try to figure that out. But it can, most of the time it's pretty straightforward, but sometimes it's like, well, my Uncle Joe, well, he's not really my uncle, right? Okay, how do we fix this?
Yeah.
And many times, if they have time, we'll say, well, it's kind of like having money in a safe. Well, if Uncle Joe, so-called, gives you this money, put it in the bank and let's wait 60 days, right? And at that point, we don't care where the money came from. Right?
So if it's been in there 60 days, it doesn't matter?
Yeah. So the reason for that is that typically we don't want people to borrow money so that they can borrow more money. So if borrow money, you can borrow money against against real property to use as a down payment, but you can't go get like a signature loan to use to your down payment. So what happens is if you get the money and so if the money's been in your account for 60 days, there's a pretty good chance that if you did go borrow that money, it's probably showing up on your credit report.
Yeah.
Because there's a delay. So like I could go to payday lending, I could get $6,000 for whatever reason. Then I could put it in my account and there's nothing shows on my credit report. Well, between 30 and 45 days, it's going to finally hit my credit report. So that's part of the reason that there's that delay, and we call it seasoning. So we want to see the money's been in there for a certain period of time. So there are times when there's no way to document anything. And if we know early enough, we can catch that and say, there's really no other options. Let's just put it in the bank and let's just sit for 30 to 45 days, and then we know that we can go ahead and start shopping. We know the money's in there. We just can't close until after we're over 60 days, that kind of thing.
Yeah. Are you seeing in this market that more first-time home buyers are finding programs, or are they getting gifts from family members, things like that?
Most of the first-time home buyers that we're seeing, we've done a number of THDAs lately, and I've got one right now that it is a THDA, but she is getting a gift. That one's an odd one because she's getting a gift to pay off an IRS lien and some other stuff too. So,
is there a max on a gift that you can receive?
Generally speaking, these down payment assistance programs don't want you. Let's say you got a 50% gift, right? To be, to go to an extreme to make a point. Well, if I'm buying a $200,000 property and I got a $70,000 gift from my parents, well, what do you need? What do you need the down payment assistance program for? Just do a regular loan. So there's a point like USDA, for example, won't allow you to, if you can qualify for something like a conventional loan with 20% down, then they won't let you do a USDA loan. So when we're showing assets, if you show that, I got all this money in the bank, but I want to do a USDA, then wait a minute, why? I don't want to subsidize you buying a place because you got all this money. So, from our standpoint, we tell the client, just give us enough information. We don't need to know about anything else. So I guess there is a point where you on a down payment assistance program that you can get too much as a gift, but the other program, like a conventional loan, there's some, if you're buying investment property, doing different things, it depends on some of the programs, but generally speaking, a primary residence, you can get a gift for as much as as much as you want.
Cool. And last one, which has been probably the most common one prior to this last year, is seller pays.
Yeah.
Those went out the door over the last year or so, as far as trying to get sellers to help out with that. But now we're kind of seeing a shift a little bit in the market. We're seeing more sellers willing to adjust the price, come down some on closing costs, things like that. Are you seeing more contracts come in that way?
Absolutely, yeah, and that's been great for our veteran clients.
Yeah,
first time home buyers and all those guys. In general, we're seeing that still anything under 200 is still a little crazy, but we are seeing some softening to the point where it's still a good offer, but we're able to get a little bit of seller pays in certain cases, and so we are seeing more of that, but it's in pockets. You guys, that's the stuff that if the place is really priced right or not.
True.
I still see stuff that comes on. It's like, oh wow, that's a little for that 180 a square foot for a place that needs a full remodel.
Yeah, I was having that conversation with Lincoln earlier. It's like people are still wanting 2021 prices, and buyers are thinking market's getting ready to crash. So it's like, where do you meet in the middle?
Yeah. yeah, and it's been that's been. I mean, I've got close to 60 pre-qualified, pre-approved that are just shopping. They're we call them every week. Paul called every one of them today, checking on them. Leaving voicemails, talking to them, and they're like some are. We're trying to talk them off the ledge. Don't stop looking. Others are, well, I'm gonna wait till this bubble bursts. I'm like, this is East Tennessee. I've got a great, by the way, I got a great podcast for you all to listen to. It's Brian Buffini. If you don't know Brian Buffini,
I've heard of him.
Yeah. So he's got a podcast, and he interviewed an economist. He was Reagan's economist that came up with supply side economics, and he was from California, and he was, but he spent half of the podcast talking about you've got to move to Tennessee. Tennessee's wonderful, right? I live in Tennessee. Brian Buffini's in Southern California. He said you're going to have to leave California to move to Tennessee. I mean, it was like I don't know, a program about Tennessee is what it felt like. But he was just talking about the economics. And so I say that to say that we're going to continue to be strong because people are moving. They're going to be moving continue to move out of those states.
Yes.
He said, if you don't move to Tennessee, move to Florida, move to Texas, right? Get out of California.
Yeah, it's anything with the states that have no income taxes and things like that. It's going to see the big influx, and you're going to see a big leaving, which New York and California both have seen record numbers of citizens leaving. So
and I don't know. I saw a client the other day that said that evidently Johnson City's got some sort of a $500 gift for if you're an information worker, like a remote worker. If you fill out this application, then you can get $500 for moving to Johnson City. I'd never seen that before. This guy's in IT and that type of thing. So it looked like I'll send you guys the link, but it was you can get $500 towards a Trek bike. You can get $500 in cash. You get all these different things. They were encouraging information. IT type people that could work remotely to move. Had to make at least $50,000 a year. You had to do this, do that. I'd never seen it. That's pretty cool. So, but there's still a lot of recruiting going on. But I don't see. I mean, we kind of got off on a tangent talking about well, there's going to be a bubble burst. And, when we buy these things for 30% off, well, there's just no inventory.
No, that's why I was telling a new agent earlier. There's not enough on the market for the prices to go down. And the rates are going to probably change a little bit, but you're not going to see a lot of price difference.
And the expectation, and I'll probably talk about this Tuesday when I come by for our lunch and we're actually be in person, but the prognosticators are telling us that we're going to see probably the end of first quarter we're going to see a move down in rates. And so so I'm talking, and I did a video for the folks that we send out every Thursday to our pre-approved looking, and I was like, well, do you wait or not wait? Well, now's the perfect time to buy because yes, the rates are going to be higher, but you're not going to pay $30,000, $50,000 over asking to get it. And what I'm concerned about is that let's say rates drop a point, we're back down maybe in the fives, then there's going to be this feeding frenzy, and there's going to be, so you don't have time to shop. Okay, you've been here 15 minutes, either make an offer or get out, back to the way it was. And so I think that, even if you're in the fives, within the next 24 months, we're going to be refinancing everybody. That's my belief. Now, I may be wrong, but if you're going to refinance anyway, so buy it at 6.5. I mean, rates have come down a little bit. So last month we were in the low sevens, probably in the high sixes, mid sixes right now. So we've got some relief, but I'm telling and I'm trying to come up with not just, hey, I need the business, you need to buy now, right? I mean, the clients don't appreciate that as much as why should I buy now? Well, all those different reasons. You got more time. You got some negotiating capability.
It's all about how you educate them.
Yeah, might get some seller pay closing costs. All those different. I mean, for first-time home buyers, I think now's the perfect time because the end of first quarter, it's all that stuff is going to be bought up again. And you know, again, listening to Brian Buffini, he was saying, well, he was looking at doing some investment in Southern California. He said 50% of the cost of any like new multifamily construction thing was 50% had to do with basically governmental red tape. He said, so I'm not investing in California. He said, I'm investing everywhere else. Tennessee,
Exactly.
different places. So, you know, I got people coming, you know, you all see it all the time, coming in buying single family residences. And so what are you going to buy? You may not buy $500,000 for investment for a single family. You're going to buy 125, 150, the various thing that we're competing with first time home buyers.
Mm-hmm.
So, you know, if I were, you know, in that position, that would be, I'd be trying to find something. It's easier said than done.
Absolutely.
So, I don't know, does this make sense? I can't.
Oh, yeah, absolutely.
I talk about it all the time, but you know, sometimes I ramble a bit. So.
No, that's great. Yeah, that was pretty much all the points I wanted to cover, and grateful to have you on here as always. And
Thank you, Tim.
Yeah, this is fun. I'd rather be there because it's you know, so there's that food there. It's making me hungry. I can't see what it is, but it's good there.
You gonna be in Tuesday?
I have coffee. I do have coffee, and I got some cookies in there.
We'll see you next Tuesday.
Yeah, that sounds great.
And we're going to celebrate December birthdays after the lunch and learn.
Ah, there you go. Who's the December birthdays?
It's me, Ariel, Keisha, and Joey.
Oh, okay.
We got a big crew this week.
Big crew. All right. Well, you all make sure you cut out some time on Thursday to come to our Christmas party. We'll have everybody get their cameras out for video for Dustin on the karaoke machine.
As long as there's spiked eggnog, I'll get on the karaoke machine.
It won't take that to get you on the karaoke.
No, we know better, don't we?
Awesome. Tim, thank you so much, buddy.
Thank you,
Appreciate you.
Tim.
Tell Paul, get to work.
I will. He's focused. He's working on it.
Tell Paul to quit ignoring you.
Yeah.
Bye.
Thanks, Tim.
Bye.
What is the quality on
When I close out the lights,
so good, the way the lighting and everything is?
It does?
It looks